1970, they lost 11,000 tons. Down, they went from 20 to 9, but they sold another 1,000 tons in the 1970s to suppress the price of gold, which failed because it always does. But by 1980, they had kind of were down to 8,000 tons, and they stopped. Why did the U.S. stop selling gold? We've never sold any significant amount of gold since. The answer is, in my view, is that they can't go below that because that's the amount of gold the Treasury needs to back up this gold certificate on the Fed's books. So, okay, just kind of put that into one side. That asset is valued on the Fed's balance sheet at $42.22 an ounce. The price of gold, look today, it was about $1,850 an ounce. Now, so, what's, as I say, sauce for the goose is sauce for the gander. If we're going to mark the mortgages to market in a world where interest rates have gone up and the mortgages have gone down, it's only fair to mark the gold to market. And if you mark that gold to market at $1,850 an ounce versus $42, voila, you would find that the Fed has another approximately $350 billion of hidden assets. So I think that takes care of the solvency problem. So before we beat up the Fed on mark to market on mortgages, that's fine. But have a look at the gold and realize that they have a hidden asset, a shadow asset on their books that's worth in the hundreds of billions of dollars.
We've heard from Jim that the Fed has hundreds of billions of dollars of a hidden asset, and that hidden asset is a gold certificate held by the Fed and backed up by real gold in the U.S. Treasury. When the time comes, the Fed will definitely use it to back the new dollar. They'll even buy more gold from the public, and therefore the price will go up significantly. But how much exactly is the price of gold will go up? Is it a big deal?
I think it would be a very big deal. But it begs the question, if you're going to revalue it, to what level do you revalue it? So everyone said, well, the market's 1850, that's about where it is today. It goes up and down, but so revalue it at 1850. That could be highly deflationary. And the reason is, in effect, you're putting yourself on a gold standard. You don't have to. That's why they won't do it. They don't want to touch it. But if you did, you would be saying, hey, gold's really worth 1850 and we have this much gold, et cetera. But at that point, analysts would sort of turn and say, well, okay, well, you're back to a kind of gold standard. What's the relationship between gold and money or currency or US dollars and others, the money supply? But what is the relationship between gold and money supply? What you would find is that at 1850, the gold relative to the money supply is about 2%. Whereas historic gold standards were run with somewhere between 20 and 40%. Bank of England in the 19th century managed a successful gold standard between the Congress of Vienna and World War I with about 20% gold. In the U.S., through most of the 20th century, at least the first half, ran a gold standard with about 40% backing. It was actually the law. The law until the late 1960s, I think 1968, was that the Fed money supply, base money, could not be more than 2.5 times the value of gold. Originally at $20 an ounce, $20.67 an ounce, later $35 an ounce. But whatever that number was, times the amount of gold, that had to be 40% of the money supply, and the money supply could not be greater than that. And then they got rid of that in 1968 because of the war in Vietnam. But the point being, 20% has worked, 40% definitely works. The Austrians like to bang the table and insist on 100%, but maybe, but that's historically not been required. You just need enough gold to be able to give gold to people who want it when they want it. And if you're credible in that dimension, most people are content to hold the money. So as a hypothetical, you can say, well, okay, let's say we want a gold standard, and let's say that we want 40% backing of M1. M2 is a bigger number, or at least it can be. Let's just say, so 40% backing of M1, that's a conservative kind of gold standard, not extreme, but reasonable.
From February to March 2020, the Fed has printed $2 trillion. The impact of that is our money supply goes up, and so does our inflation. With massive price increases in food and energy, gold prices would have to rise too, right? And if the Fed uses 40% gold backing to back the new dollar, and with the current high inflation that we have, what would the price of gold be? Jim Rickards gives a staggering gold price prediction. Let's listen to Jim.
Given the amount of gold the United States has, what would the price of gold have to be in order to maintain that ratio? The answer is about $15,000 an ounce. And people say, well, Jim, you used to say $10,000 an ounce. Well, that's true because it was true at the time. But when you expand the money supply, the number goes up, right? Because the amount of gold is fixed. So yeah, it was 10,000 not that many years ago, and today it's 15,000. Well, if you say gold's worth 1,800, people are going to say, well, give me the gold. I'll take all the gold you got at that price. And then they're going to have to shut the gold window again, and that has its own problems. But in other words, you would be, it's not clear how it would work. I mean, there are a lot of ways it could work mechanically. It's not clear what the government would actually do. But my point is, if you try to mark gold to market on the Fed's balance sheet, you're opening Pandora's box. Because you would be getting a lot of people, bankers, analysts, Wall Streeters, investors, to sit up and take notice and say, well, hey, what is going on here? You're back in the gold business. Well, you got the price wrong because you can't back up your money supply at that level. And the truth is you can't.
The everyday American has been 40 years at this point of being miseducated on the topic of gold. So they're not very much into gold. You go around the world, you get very different results. Switzerland, Germany, Austria, they love gold. Of course, China, Asian countries. I think Australians have a much better sense than Americans do. So there are the buyers of gold. But you say, well, okay, who are the big buyers of gold? The answer is the central banks. Now, right there, that should tell you something. So these are the most powerful, most plugged in, most heavily monetary institutions in the world. And they're the ones buying gold. Now, they would have you believe that gold's not money, gold serves no purpose. It's the first ones to say, John Maynard Keynes said it was a barbarous relic, which he never said, by the way. He said something, he used the phrase barbarous relic in reference to the gold exchange standard of the 1920s, which was a hybrid gold foreign currency standard, but the foreign currency is not gold. So he said that's a barbarous relic, but he never said that about gold himself. And actually, toward the end of his life, he favored, at Bretton Woods, he favored a global currency called the backward, backed by gold. And, it's not guesswork, they're papers he published at the time. And that was rejected by the United States, which kind of ran the show, partly because not to get too down in the weeds, but our Undersecretary of the Treasury, who was our representative at Bretton Woods, was a Stalinist agent. He was a communist. This didn't come out until the 90s, after the fall of the Soviet Union, when a lot of classified information was released, all KGB files, etc. But it was revealed and fully documented in a book by Ben Style called Battle of Bretton Woods, that he was a communist agent. So what was he trying to do by insisting that, by running Keynes's idea off the road, insisting that the US dollar be the anchor? He was trying to destroy the British Empire, which he did, because he knew that there were far more claims on the Bank of England than they had gold, and that would be inherently unstable, and that would derail sterling as one of the global reserve currencies and undermine the British Empire, which it did. So that's a little bit of a backstory, but it goes to the point that Keynes was an advocate for gold at different times in his career and at the end of his career, and that when the central banks are buying, I should tell you something. Now, I've said for years, I've always pointed to Russia and China. Russia has almost quadrupled their gold reserves in the last 12 years, starting in 2009 through 2021. They've almost quadrupled from about 600 tons to about 2,400 tons. China, the same, from about 600 tons to about just under 2,000 tons that they report, but they're non-transparent. They have a lot more gold than that stashed in something called SAFE, the State Administration on Foreign Exchange, which is a secretive Chinese sovereign wealth fund run by an ex-PIMCO guy, by the way. He knows what he's doing. And they're non-transparent. So the People's Bank of China is kind of transparent. SAFE is non-transparent. So every 6-7 years, what you'll see is the People's Bank of China will announce, well, we've increased our gold reserves by 400 tons or 500 tons or whatever, as the case may be. And well, it sounded like they went out the night before and bought 600 tons. Good luck trying that. You can't do it. Well, what it means is that SAFE took some of the hidden gold that they had been acquiring slowly and in an accounting entry, moved it over to the People's Bank of China, and boom, there's 500 tons overnight. But of course, they had it all along, and they still do. So they probably have more. So Russia and China are big acquirers, tripling and quadrupling their gold reserves. But now we're seeing it in a lot of other countries. In the Philippines, Vietnam, Mexico, Iran is a major buyer, but non-transparent. Turkey has drastically increased its gold reserves. These are major countries, and they're adding. So I look at that, and there's very good data from the IMF and the World Gold Council, so you can find this information. But the one that was just like not doing anything was Japan. They had about 600 tons, but they had 600 tons for 30 years. And then just about, at this point, about 6 months ago, so late last summer, they bumped it by, I believe it was 50 tons, perhaps more. I look at the exact number, but it was over 50 tons overnight. It just went from, 600 tons to 650 tons, just like that. Well, here's what you know. Same thing I said about Russia. You can't buy 50 tons overnight, or you couldn't even do it in a month. I mean, the dealers would be working the order, it would be disruptive to the market. It would leave a lot of fingerprints, put it that way. But what it tells you is two things. Number one, Japan had the gold all along. They had it in some sidecar or side account or Ministry of Finance hidden account, as the case may be, and they chose to move it over to their reserve position, which they can do. That's an accounting entry, but they had to have had the gold all along, because you can't buy that much that fast. So then that begs the question: well, why all of a sudden? Why now, after decades of holding your gold level constant, you all of a sudden step up in a big way? A lot of possible answers to that. One, China's making noises about invading Taiwan. Well, if you're going to invade Taiwan, why not invade Japan while you're at it? It's just another chain of islands as far as the Chinese are concerned. And after this happened, right around the time, maybe shortly after the U.S. debacle in Afghanistan, which was, the worst foreign policy, military disgrace, humiliation in U.S. history that I can remember. I don't know how far you have to go back to find a worse turn of events, and that there it was. Well, all of a sudden, allies all over the world, Israel, Japan, Taiwan, they're questioning the United States. Like, hey, we're under your nuclear umbrella. You stand by us through thick or thin. Here you leave Americans behind enemy lines. Perhaps, now this is speculation, but perhaps Japan sees the threat to Taiwan, feels they may be in the sights of the Chinese, feels the United States may not be as reliable as one had thought, and says, well, we now have to step up a little bit financially, militarily, et cetera. And they're doing that. But that aside, that's a little geopolitical speculation, but that aside, the gold is real. They put it on the books. So the biggest buyers of the gold in the world are the central banks. By the way, from 1970 to 2010, central banks were net sellers. Now, some bought and some sold, but on net, they were net sellers. We had Brown's bottom in 1999 when the UK sold half their gold at the lowest price in about 60 years. They literally hit the bottom at about $200 an ounce, give or take. But since 2010, central banks in the aggregate have been net buyers, and that buying has accelerated. So what does that tell you? It tells you that the most knowledgeable players in the world are adding gold to their reserves because they consider that a prudent hedge to the US dollar, if you have US dollar inflation, or to collapse of confidence in central bank currencies generally, or they're just saying, hey, we're part of the club. By the way, here's a good trivia question for you. If you're in a bar and with a lot of brainy economists around, ask them, bet them a drink on this. Ask them what percentage of U.S. reserves are in gold. The answer in China is about 2%. Russia's about 20%. You know what the percentage is for the United States? 75%. The U.S. does not rely on euros and Aussie dollars and Canadian dollars for its reserve position. 75% of U.S. reserves are in gold. So don't let any central banker, don't let Jay Powell or Janet Yellen or any of these others tell you that gold's not a monetary asset. We have the largest gold stash in the world, and 75% of our reserves are in gold. So that's the U.S. As they say, watch what they do, not what they say. When people talk about the price of gold, people say, well, gold went up, and then they say gold went down. But gold really didn't do anything. Gold is an element. It's atomic number 79. It's a very nice, very attractive metal. What changed was the dollar price. That's what people mean when they say gold went up, they mean the dollar price went up. And if they say gold went down, they mean the dollar price went down. But what does it really mean? Is that telling you something about gold, or is it telling you something about the currency? And I would say when the dollar price of gold goes down, that means the dollar got stronger. Each dollar buys you a little more gold. And when the dollar price of gold goes up, I would say the dollar got weaker because each dollar buys you a little less gold. When you translate it into weight, I always think about gold by weight. That's why I keep talking about tons and so forth, metric tons. So fluctuations in the dollar price of gold tell you more about dollars than they do about gold. It tells you about the strong dollar and the weak dollar. So as the dollar price of gold goes up, what it means is that the dollar is getting weaker. Now, so if you want to know the dollar price of gold, just do a long-term forecast on the currency, and you'll get to the dollar price of gold very quickly. So when you say, is gold a good asset? Is it a good diversifier? Is the price going up in the long run? Great questions. And the way I think about it is, well, what's going to happen to the dollar in the long run, up or down? Well, what's the history of all central bank currencies? What's the history of all fiat currencies? What's the history of inflation? They all go down over time, not all at once. And that's another source of confusion because people look at, well, the dollar-euro cross rate, or they say euro to dollar cross rate, is the most heavily traded liquid, foreign exchange cross rate in the world by far. So, and in the past, I would say 2 months, euro has fallen from about $1.20 to today it's about $1.13. That's a significant decline in the value of the euro and a significant increase in the value of the dollar. So a lot of times when people say the dollar is stronger or weaker, they're actually not thinking about gold along the ways we just discussed. They're thinking about some dollar index. But if you peel back the layers of the onion for every index, Dow Jones, Bloomberg, Fed, it's all basically the euro-US dollar cross rate. So yeah, there's some Canadian, Australian, and yen and sterling. There's some other currencies in there, but the euro is the line of shares. All these indices are really euro-dollar cross rates. So when people say the dollar is stronger, well, it's another way of saying the euro is weaker. But currencies tend to trade within a range. They'll get here or they'll go here, but they're not like stocks. Major currencies, they don't go to zero. I mean, Zimbabwe, yeah, but the Australian dollar, euro, they're not going to zero. But they don't go to the moon the way Apple stock or Amazon does. They can be strong or weaker, but they tend to trade within a range, which makes them interesting to trade because you can spot those inflection points. So right now, when people talk about the strong dollar, they're really referring to the dollar value of a euro. But you could have a situation where gold is going much higher in dollar values, and that would be, as I said, a weak dollar. And yet the euro could be falling faster than the dollar. So people always look at the euro and they say strong dollar, weak dollar compared to the euro. My only advice is look at the dollar price of gold. Use that as your thermometer. A doctor walks into the room, they see the patient, they don't know anything. What's the first thing they do? They take your temperature. So if you want to take the dollar's temperature, look at the dollar price of gold.
But a global recession is highly unusual, and that appears to be what we're heading for. So my forecast, I do update them, but big picture, it goes as follows. So what is Jay Powell doing? First of all, March 1st, 2022, the Fed fund policy rate, interest rates were 0. And we're now at 4.5%. Even in the Volcker days, we never went up 4.5% in 10 months. Not that fast. And so here we are. So what is Powell doing? Well, he's given 5 speeches on the subject. I don't know why Wall Street doesn't listen, but he keeps trying. He said the same thing every time. He said, inflation is job one. We're just going after inflation. Believe us. There is going to be a recession. Unemployment is going to go up. There's going to be pain. I've never heard a Fed chairman use the word pain. He used it 5 times in one paragraph in the Jackson Hole speech. And that's what we're doing. And believe us when we say it.
According to Jim Rickards, a global recession is coming and it's going to be painful. Unemployment will go up, the economy is slowing down, and the Federal Reserve has already used every single tool that they have. Inflation has come down, but for a really bad reason. We will get into the reason later in the video. There's the myth of something called the terminal rate. Simply put, it's a rate that the Federal Reserve needs to reach so that inflation will come down on its own without further rate hikes. Wall Street said the Fed is already at the terminal rate, so they don't need to raise it anymore, but the Fed is saying, no, we haven't reached the terminal rate yet, so we have to keep raising it until we reach the 2% inflation target. So the question is, how long will the Fed keep raising the interest rates? We're already over 5% now, and the Fed's still planning to raise it even more? With the current high interest rate, these tech companies already laying off a lot of their employees because they have to tighten their finances. What if the Fed raises it even more? Let's find out.
Now, how long will he raise rates? How quickly? And what's he trying to do? Powell is trying to get to something that he calls the terminal rate. But the definition of the terminal rate is it's a rate that's high enough to cause inflation to come down on its own without further hikes. So we'll get to a level, and then inflation is coming down, by the way. And in the last 5 months, it's gone from, in the U.S., it's gone from about 9% to 8.7, 8.2, 7.4, 7.1. So it is coming down. Having said that, the target is 2%, and 7.1 is still a far cry from 2. So he's not there, but he's making progress. So here's I hate to use the word conundrum, but it kind of is. Wall Street's saying, you're done. You did it. Mission accomplished. Inflation is coming down. You got what you wanted. Give it time. Stop raising rates. You're going to kill the economy. But the Fed is saying, well, we actually don't know. We can't untangle it. Yes, inflation is coming down. That's objective. But is it coming down because we're still raising rates, or is it coming down because we're at the terminal rate? Those are two different things. Right now, and this is what Powell's been saying, the Fed leans to the view that they're not at the terminal rate, that inflation is coming down because they're raising rates. They have not achieved the terminal rate. So Powell and the Fed have said, yeah, inflation is coming down, but it's because we're raising rates, not because we're at the terminal rate. We're going to get to the terminal rate, probably 2 more hikes, and then we'll pause. And then if we're right, we'll just let inflation come down on its own. And that may take a year. So all this stuff about the Fed pivot and cutting rates and all that stuff, I mean, the Fed's thinking mid-2024 before they do that. Now, Wall Street are saying, no, you're not going to get that far. You may be at the terminal rate already. You're definitely going to cause a recession. It'll be more severe than you think. And rates are going to have to come down sooner than people expect. In other words, you've already achieved the terminal rate. You just don't know it. And you'll probably be the last to know. So with Wall Street, with cheerleaders, sending that message, but with some serious market indicators, including yield curves, sending that message, why is Powell sticking to the game plan as I described it? And the answer goes back to 1980, believe it or not, and what's called the Volcker mistake.
Jim Rickards said something about the Volcker mistake and why Jerome Powell is still raising the interest rate and not cutting it yet. The famous Fed pivot, as Wall Street calls it. Jay Powell doesn't want to repeat the Volcker mistake by cutting the interest rates too early and failing to bring inflation down. Do you know why the interest rate was raised to 20% back in the 1980s? It's because of the Volcker mistake. The tale goes as follows. In the late 1970s, inflation was going up a lot, and therefore the interest rates rose from around 4.5% to 10%. But that 5% raise took 3 years, from 1976 to 1979. Meanwhile, the current rate hike that we have now is the fastest in history. We went from 0 to 5.25% in just 1 year. Back in the 80s, we had a recession, and the chairman of the Fed, Paul Volcker, had to cut the interest rate down by 7%. Not 0.7%, but 7 full percentage points. He cut the interest rate from 17% to around 10%. And after that pivot, he raised it back to 20%, and 3 years later in 1987 the rates finally came back to normal. Back then, we needed 10 years in order to finally win the inflation fight. And now what? We're expecting it to win in a couple of months? The Fed just raised the rates fastest in history and people expect to bring it back down? Let's get into the detail.
People forget that there was a recession in 1980. It was sharp but quick. It was over very quickly. It had nothing to do with monetary policy. The Carter administration issued some dopey regulation on a ceiling on credit card interest rates. And the industry said, fine, we're just not going to lend anybody any money. The economy fell instantly, kind of like a smaller version of what happened in 2020 with the pandemic panic. And then they said, oh, sorry, just kidding. And then they took the ceiling off and then things got back to normal. Now, this was a time when farmers around the country were driving front loaders and tractors to Washington, and they were circling the Fed building, and one guy drove his tractor up the steps of the Fed, and Volcker was being burned in effigy. That all happened. So it was a little bit of pressure, and of course Congress was up in arms and the White House was up in arms. So Volcker, not quite panicked, but he cut interest rates 7 percentage points, not 0.7, 7 full percentage points to deal with the recession, which, number one, was unnecessary because the recession was caused by a policy blunder from the White House, which was quickly corrected. And number two, he had not won the fight against inflation. Well, after he cut rates and we came out of that very quick sort of snap recession, inflation got even worse. And that's when Volcker had to raise rates to 20%. And Volcker, in hindsight, and he said this in his last book, just before he died, he said, we shouldn't have done that. We should have stuck to our inflation mission. So now Powell, remember, Powell's not an economist. He's a lawyer. So he kind of thinks like a lawyer. I can relate to that, looking at both sides. Powell does not want to be that guy. He does not want to be the guy who balks early and cuts rates, the famous Wall Street pivot, before the battle against inflation is won, because the outcome could be exactly what Volcker experienced, which is inflation wasn't done, doesn't go away, comes back stronger, and then you do have to destroy the economy, as we did in 1981-82. That was the worst recession. That was far worse than the little one in 1980. That was the worst since the Great Depression. We've managed to break that record several times since then, but at the time that was horrific. But Volcker and others have said that was a blunder he never should have done. So Powell does not want to give up the rate hikes too early because he does not want to repeat the Volcker mistake. He does not want to be that guy. And that's what's driving him, even as Wall Street screams, you're already there. So the question is, that's the lay of the land. There's the two competing sides. How does this play out?
We learned a lot from Jim about the current situation and what Jerome Powell will be doing. But there's more to that story. Powell doesn't even understand what's going on in the real world, which is inflation itself. There are two sources of inflation, the supply side and the demand side. We are at the supply side inflation, which means the supply of goods is scarce but the demand is high and therefore the prices go up. But supply side inflation can transform into demand side inflation, and this is where the dangers begin. People's spending behavior changes and they're worried that something worse will happen, and then they grab everything they can, and therefore the demand rises, and you got yourself inflation caused by an increase in the demand side. That's what most people don't understand, including Wall Street. Wall Street said inflation will come down on its own because we've reached the terminal rate. But Jerome Powell thinks we are not done yet, and therefore he will raise rates even more. And what does Jim Rickards think? Does he think Powell is at the terminal rate yet?
In my view, Powell probably is there. He probably is at something like a terminal rate. He probably doesn't have to raise interest rates anymore. He doesn't believe that himself. His models tell him otherwise because they're relying on the Phillips curve, which is junk science. I mean, the last time I looked at a Phillips curve, it was flat. At least where I went to school, curve was curved. This thing is flat. There is no correlation between unemployment and inflation. There just isn't. But the Fed thinks there is. So I always tell people, don't. If you want to forecast Fed policy and understand the Fed, don't think like a rational person. You have to think like the Fed. Because you have to get inside their heads or else you're going to get it wrong. So they're looking at unemployment, which is the lowest. The unemployment rate is the lowest since 1969. Well, if you believe in the Phillips curve, then that's a sure sign of inflation. As I say, even though it's coming down, it's still pretty high. So they think they have to keep fighting this fight. But here's what they're missing. Here's where it all falls down. Yeah, inflation as measured, CPI, PPI, personal consumption expenditure, core, non-core, year over year. There are like 20 different ways to measure it. It is coming down, but there are two sources of inflation. And it's going to sound obvious, but you got to separate them: the supply side and the demand side. They both result in price increases, but they have completely different dynamics. Supply side inflation is what we're seeing. It's what we saw in 1974 with the Arab oil embargo during the Arab-Israeli war when they cut us off from oil. And, you had to line up for gasoline. I lived through that. Bare shelves, and you couldn't get certain things. It wasn't that every supermarket shelf was bare the way it was in East Germany in the 1950s, but something was always missing. And that's still the case today. So, of course, prices went up and, people were trying to pay whatever they had to get what they needed. And energy prices were a big driver of that. So that feeds through as a form of inflation. The other kind of inflation is from the demand side. So the supply side is called cost push. Costs go up and they push it onto the consumers. The other kind is from the demand side. It's called demand pull. And basically, consumers have a change in mentality. They're worried about inflation. They would say, hey, I was thinking about buying a refrigerator. Gee, I better go buy it today because if I wait for 6 months, the price is going to go up. Or apply that to anything, a new dress, new suit of clothes, whatever. And so you're pulling demand forward, and it's behavioral. And that will also drive prices up. But they're very different things. Now, cost push can morph into demand pull. That's what happened in the 70s. It started from the supply side, but by the late 70s, 80s, and Volcker, which we've just been talking about, it had tipped over into the demand side. That hasn't happened yet. We've had the supply side inflation, the cost push. It hasn't yet tipped into demand pull. It hasn't really affected consumer behavior that much in terms of people anticipating more inflation. It could, but it hasn't happened yet. Here's why that's an important distinction. Cost push inflation negates itself. The old saying that the cure for high oil prices is high oil prices because people can't afford it. Maybe if demand is inelastic, if you got to fill up your Ford F-150 truck with gasoline to take the kids to school or go to work. But if you're unemployed, you're not buying any gas because you're not leaving the house. So it tends to negate itself, whereas demand pull feeds on itself. Powell has not made that distinction. And if I'm right, I think I am right, and the evidence backs that up, this inflation will come down, not because the Fed is raising interest rates, but because higher prices destroy demand all on their own. If I used to pay $75 to fill up my truck with gas, and now I have to pay $150, which is about right, I'll do it because I got to get to work. But that's $75 I'm not going to spend on something else. I'm not going to go out for dinner. I'm not going to go to a show, a concert, or buy a new camera, whatever it might be. So it does tend to depress demand, destroy demand, and hurt the economy. And then it slows down, and then the inflation comes down on its own. That appears to be happening. But Powell hasn't really made the distinction. He's fighting the last war. I hate to use a cliche, but he's fighting the Volcker War. And what he's got looks a little bit more like the Herbert Hoover War. That looks a little bit more like the 1930s than the 1970s. So the bottom line on all this is the Fed is going to raise rates at least twice more for the reasons I mentioned. Powell doesn't want to repeat the Volcker mistake. He thinks the battle's not won. He has to get to the terminal rate. In reality, he's probably already there, if there is such a thing as a terminal rate. It's another one of these things they made up. Inflation is coming down, and so will probably continue, but for really bad reasons. So 90% is the critical threshold. The U.S. is at 131%, highest in history, which means we are well past the point where you can borrow your way to growth or you can borrow your way out of a debt crisis. And we were heading for a debt crisis. So the way it works is raise interest rates, tighten money, reduce the balance sheet, et cetera. Get unemployment up. It doesn't sound like a desirable goal, but that's what it takes. And that's what happened in 1982. Get unemployment high enough so people are buying hamburger instead of steak. They're buying, whatever is the least expensive thing on the shelf, day-old bread instead of new bread, or they're not buying gasoline because they're not going to work, et cetera. That will bring prices down, but at a very high cost, which we just talked about, which is high unemployment and lower productivity. Meanwhile, the U.S. debt keeps going up. We haven't really talked about the debt. That part of it looks like 1981. But if you throw in a global financial crisis, then it starts to look more like 2008. Yeah, well, that's like a glacier. Glaciers are extremely powerful, but they move extremely slowly. There's some exceptions, but they kind of like, an inch a year, a couple inches a year, but they move mountains. I mean, they create rivers, they create canyons, they move mountains. They're extremely powerful, but slow. That's a good metaphor for the impact of debt. And when I talk about debt, in particular with the United States, but you can apply this to any country, I focus on the debt to GDP ratio, because you can't really talk about debt in isolation without thinking about the capacity to pay the debt. And a simple example, if you have a $50,000 balance on your credit card and you're making $30,000 a year and trying to pay rent in New York, et cetera, good luck. You're probably going to go bankrupt or at least default on that card. But if you owe $50,000 on your credit card, but you're making $5 million a year, it's, you just write a check. It's no big deal. My point is, you can't look at a $50,000 debt and decide if it's a problem or not unless you compare it to the income. And if it's too low, it's a problem. And if the income's high, Not a problem. So that's why you use the debt to GDP ratio. The U.S. just hit $31 trillion in national debt. That is national debt, almost all of it in the form of U.S. Treasury securities. Not all of it. There are other obligations, but mostly U.S. Treasury securities. Well, is that a problem or not? Well, one way to answer the question is compare it to GDP, do the ratio. The answer is that ratio is now a little over 130%. What was it in 1980 when Ronald Reagan was elected? The answer is 30%. 30% is completely comfortable. That's like the person with the $50,000 debt who's making millions. No big deal. 30% is comfortable. 50%, yeah, getting up there. Angela Merkel and all her years in Germany, and there's a lot of research to back this up, says that 60% was the limit. And that's what the Maastricht Treaty that created the European Union and the European Central Bank, that was their goal. They said, don't go over 60%. If you do, you're expected to take measures, raise taxes or reduce debt or reduce spending, do something to get that back down under 60%. If you say, what's the critical threshold where, water turns to steam, or, water turns to ice, or something changes in such a way that it's not the same. It's radically different, but it happens very quickly. The best research says the answer is 90%. And this comes out of, Ken Rogoff at Harvard, also Carmen Reinhart, who's now the chief economist at the World Bank. But they've looked at hundreds of cases over hundreds of years. And I like that because it's not just, kind of cherry picking data. Developed economies, developing economies, economies that issue debt in their own currencies, ones that issue debt in other currencies, principally US dollars, et cetera. So, a wide variety of case studies. And they show that when your debt to GDP ratio goes over 90%, your multiplier of additional debt goes below 1. So just to put that in context, at 30%, if I borrow $1 and spend $1, I might get $1.30 of growth. Assuming you spend it wisely. That's a big condition. But you borrow $1 and spend $1 and get $1.30 of growth. Okay, the debt was productive if you put it to good use. But that $1.30 gets smaller and smaller. As you get closer to 90%, it goes to $1.20, $1.10, $1.05. Past 90%, roughly, you borrow $1 and you spend $1 and you only get 95 cents of growth. You don't get your dollar back in terms of GDP. And then 90% and 85%, et cetera. So 90% is the critical threshold. The US is at 131%, highest in history, which means we are well past the point where you can borrow your way to growth, or you can borrow your way out of a debt crisis. And we were heading for a debt crisis. Now, Stephanie Kelton, she's the big brain of modern monetary theory. She's a professor at State University of New York. She says it doesn't matter. That they always point to Japan. Japan is at 280%, way past any member of the peer group. China's probably higher. China's a little more opaque because they are, but also they don't have as much national debt. If you look at the national debt to GDP, it's modest, but they have an enormous amount of provincial debt, and the banking system is owned by the government or controlled by the government. So when you throw in the bank debt, the state-owned enterprises, the provincial debt, and the government, so that's the real national debt. Stephanie Kelton says, it doesn't matter because you're borrowing in your own currency. So if you're Argentine and you borrow in dollars and you print pesos, how are you going to pay the dollars back unless you have, huge trade surpluses, which they don't. So they just default. Argentina is a serial defaulter and everyone expects that. If you borrow in dollars and you print dollars, which the United States does, they're like, what's the problem? Just print the dollars and pay the money back. Well, that's true. If you print dollars, there's no reason to default on dollar debt because you actually can print the money and buy the bonds. But it doesn't mean nothing else bad happens. What about inflation or hyperinflation? What about the foreign exchange rate? The exchange rate can collapse. And these modern monetary theorists show very little understanding of the international aspects. They treat the US like a closed economy, which it's not. I mean, if it were a closed economy and we didn't have to worry about trade deficits, trade surpluses, capital flows, exchange rates, foreign credit, China owning $1 trillion of U.S. Treasury securities, which they do. If you didn't have to worry about any of that, I think they'd probably still be wrong, but they'd have a better case. But you do. And they don't, they're just not very knowledgeable about any of those things. But you can think of exchange rates as a conveyor belt. Exchange rates are one way the problems go from one country to another, or good things can go from one country to another, depending on whether exchange rate is going up or down, the impact on terms of trade, et cetera. But they completely ignore all that. They also ignore the role of commercial banks. They just look at the Treasury and the Fed and look at money supply, but like kind of M0, but don't understand how commercial banks create M1 and they do their own thing. They're not on as short a leash as they seem to think. But if you read Stephanie Kelton's book, The Deficit Myth, she says, well, we don't really need a bond market, U.S. bond market. We only have a bond market as a favor to investors because it gives them a place to put their money. But why have, he said you have government spending. So the Treasury borrows money by issuing bonds, and then the Fed monetizes the bonds by buying the bonds. And that gives the Treasury the money to pay the bills, et cetera. She says, do away with all that. Just give the Fed, wire instructions for Lockheed. And if you need 5 F-35 fighter jets, order them and just send the money right to Lockheed. Why do you need a bond market? I mean, she actually says that. So, okay, legally, that might be possible, but to suggest that you can do that without consequences is nonsense. And then you say, what about inflation? Their view is as long as there's excess capacity and unmet needs, et cetera, you're not going to have inflation because there's a lot of slack in the economy. That's a legitimate debate. But they say when inflation happens, raise taxes. And then, by the way, they also say you don't need a tax system because if you can just print the money, why do you have to collect taxes? And their answer is, we collect taxes to redistribute income. Okay, well, at least they're honest. I mean, that's kind of a socialist model, but they're honest about it. But it's important to bear in mind that Stephanie was the principal economic advisor to Bernie Sanders in 2016 and 2020. And Bernie Sanders today is the chairman of the Senate Budget Committee, controls the purse strings. So coming out of Congress, and Biden's kind of a cipher. He's barely aware of his own existence. So Sanders is in a powerful position, and she's the Bernie whisperer, so to speak, who's behind all this. So if you ask the typical member of Congress, can you define modern monetary theory? They'll look at you funny. They've either never heard of it or they certainly don't know what it means, MMT, But they're acting in accordance with modern monetary theory. Whether they know it or not doesn't matter. The actual behavior of the Congress, and again, just go back to COVID 2020, because we talked about the debt to GDP ratio. So in around May or June 2020, Trump put through a $2 trillion COVID relief package, and that was when the Paycheck Protection Plan, that was $800 billion, and everyone got the $1,200 check, et cetera, et cetera. And then at the end of December, at the very end of the Trump administration, they did another $1 trillion, almost. And that's when everyone got the $600 checks. And now you're up to $1,800. By the way, those checks, that is helicopter money. That's, what the Fed does is kind of nonsense. But when it's fiscal policy, not monetary policy, and you're handing out checks, that is helicopter money. And credit to Larry Summers for saying, you're going to get inflation out of this. Well, Biden comes into office in January 2021, and he's like, not to be outdone, he did his own COVID relief package. That was another $2 trillion. And that's when we all got the $1,400 checks. They just handed them out. And then later that year, or they did the $1 trillion infrastructure package. And then just to top it off, what did we get recently was the just under $1 trillion Green New Deal. I call it the Green New Scam. Well, and the baseline budget deficit, before everything I just described, the baseline budget deficit was about $1 trillion a year. So take $1 trillion for 2020, 2021, and 2022. Add on, $2 trillion for Trump's first package, $1 trillion for his second one, $2 trillion for Biden's first package, 1 trillion for the Green New scam, and I think $1 trillion for infrastructure. That's $7 trillion on top of the $2 trillion baseline budget deficit. So that's $9 trillion piled on top of what was at the time about a $21 trillion national debt. So that's how we got to 30 trillion. That's how the ratio went from 106 to 131. These numbers are mind-boggling, and MMT says doesn't matter. But it does matter, and it shows up the way I described earlier, which is it slows growth. You don't get growth. So best case for the U.S. is very slow, weak growth, which we saw from 2009 to 2019. Worst case is you throw a recession on top of that, which we're heading for, and the U.S. will be in fiscal distress. Use the word conundrum, but it kind of is. Wall Street's saying, you're done. You did it. Mission accomplished. Inflation is coming down. You got what you wanted. Give it time. Stop raising rates. You're going to kill the economy. But the Fed is saying, well, we actually don't know. We can't untangle it. Yes, inflation is coming down. That's objective. But is it coming down because we're still raising rates, or is it coming down because we're at the terminal rate? Those are two different things. Right now, and this is what Powell's been saying, the Fed leans to the view that they're not at the terminal rate, that inflation is coming down because they're raising rates. They have not achieved the terminal rate. So Powell and the Fed have said, yeah, inflation is coming down, but it's because we're raising rates, not because we're at the terminal rate. We're going to get to the terminal rate, probably 2 more hikes, and then we'll pause. And then if we're right, we'll just let inflation come down on its own. And that may take a year. So all this stuff about the Fed pivot and cutting rates and all that stuff, I mean, the Fed's thinking mid-2024 before they do that. Now, Wall Street are saying, no, you're not going to get that far. You may be at the terminal rate already. You're definitely going to cause a recession. It'll be more severe than you think. And rates are going to have to come down sooner than people expect. In other words, you've already achieved the terminal rate. You just don't know it. And you'll probably be the last to know. So with Wall Street, with the cheerleaders, sending that message, but with some serious market indicators, including yield curves, sending that message, why is Powell sticking to the game plan as I described it? And the answer goes back to 1980, believe it or not, and what's called the Volcker mistake.
Jim Rickards said something about the Volcker mistake and why Jerome Powell is still raising the interest rate and not cutting it yet. The famous Fed pivot, as Wall Street calls it. Jay Powell doesn't want to repeat the Volcker mistake by cutting the interest rates too early and failing to bring inflation down. Do you know why the interest rate was raised to 20% back in the 1980s? It's because of the Volcker mistake. The tale goes as follows. In the late 1970s, inflation was going up a lot and therefore the interest rates rose from around 4.5% to 10%. But that 5% raise took 3 years, from 1976 to 1979. Meanwhile, the current rate hike that we have now is the fastest in history. We went from 0 to 5.25% in just 1 year. Back in the 80s, we had a recession, and the chairman of the Fed, Paul Volcker, had to cut the interest rate down by 7%. Not 0.7%, but 7 full percentage points. He cut the interest rate from 17% to around 10%. And after that pivot, he raised it back to 20%, and 3 years later in 1987 the rates finally came back to normal. Back then, we needed 10 years in order to finally win the inflation fight. And now what? We're expecting it to win in a couple of months? The Fed just raised the rates fastest in history and people expect to bring it back down? Let's get into the detail.
People forget that there was a recession in 1980. It was sharp but quick. It was over very quickly. It had nothing to do with monetary policy. The Carter administration issued some dopey regulation on a ceiling on credit card interest rates. And the industry said, fine, we're just not going to lend anybody any money. The economy fell instantly, kind of like a smaller version of what happened in 2020 with the pandemic panic. And then they said, oh, sorry, just kidding. And then they took the ceiling off and then things got back to normal. Now, this was a time when farmers around the country were driving front loaders and tractors to Washington, and they were circling the Fed building. And one guy drove his tractor up the steps of the Fed, and Volcker was being burned in effigy. That all happened. So it was a little bit of pressure. And of course, Congress was up in arms and the White House was up in arms. So Volcker, not quite panicked, but he cut interest rates 7 percentage points, not 0.7, 7 full percentage points to deal with the recession, which, number one, was unnecessary because the recession was caused by a policy blunder from the White House, which was quickly corrected. And number two, he had not won the fight against inflation. Well, after he cut rates and we came out of that very quick sort of snap recession, inflation got even worse. And that's when Volcker had to raise rates to 20%. And Volcker, in hindsight, and he said this in his last book, just before he died, he said, we shouldn't have done that. We should have stuck to our inflation mission. So now Powell, remember, Powell's not an economist, he's a lawyer, so he kind of thinks like a lawyer. I can relate to that, looking at both sides. Powell does not want to be that guy. He does not want to be the guy who balks early and cuts rates, the famous Wall Street pivot, before the battle against inflation is won, because the outcome could be exactly what Volcker experienced, which is inflation wasn't done, doesn't go away, comes back stronger, and then you do have to destroy the economy, as we did in 1981-82. That was the worst recession. That was far worse than the little one in 1980. That was the worst since the Great Depression. We've managed to break that record several times since then, but at the time that was horrific. But Volcker and others have said that was a blunder he never should have done. So Powell does not want to give up the rate hikes too early because he does not want to repeat the Volcker mistake. He does not want to be that guy. And that's what's driving him, even as Wall Street screams, you're already there. So the question is, that's the lay of the land. There's the two competing sides. How does this play out?
We learned a lot from Jim about the current situation and what Jerome Powell will be doing. But there's more to that story. Powell doesn't even understand what's going on in the real world, which is inflation itself. There are two sources of inflation, the supply side and the demand side. We are at the supply side inflation, which means the supply of goods is scarce but the demand is high and therefore the prices go up. But supply side inflation can transform into demand side inflation, and this is where the dangers begin. People's spending behavior changes and they're worried that something worse will happen, and then they grab everything they can, and therefore the demand rises, and you got yourself inflation caused by an increase in the demand side. That's what most people don't understand, including Wall Street. Wall Street said inflation will come down on its own because we've reached the terminal rate. But Jerome Powell thinks we are not done yet and therefore he will raise rates even more. And what does Jim Rickards think? Does he think Powell is at the terminal rate yet?
In my view, Powell probably is there. He probably is at something like a terminal rate. He probably doesn't have to raise interest rates anymore. He doesn't believe that himself. His models tell him otherwise because they're relying on the Phillips curve, which is junk science. I mean, the last time I looked at a Phillips curve, it was flat. At least where I went to school, curve was curved. This thing is flat. There is no correlation between unemployment and inflation. There just isn't. But the Fed thinks there is. So I always tell people, don't if you want to forecast Fed policy and understand the Fed, don't think like a rational person. You have to think like the Fed. You have to get inside their heads or else you're going to get it wrong. So they're looking at unemployment, which is the lowest. The unemployment rate is the lowest since 1969. Well, if you believe in the Phillips curve, then that's a sure sign of inflation. As I say, even though it's coming down, it's still pretty high. So they think they have to keep fighting this fight. But here's what they're missing. Here's where it all falls down. Yeah, inflation as measured, CPI, PPI, personal consumption expenditure, core, non-core, year over year. There are like 20 different ways to measure it. It is coming down, but there are two sources of inflation. And it's going to sound obvious, but you got to separate them, the supply side and the demand side. They both result in price increases, but they have completely different dynamics. Supply side inflation is what we're seeing. It's what we saw in 1974 with the Arab oil embargo during the Arab-Israeli war when they cut us off from oil. And, you had to line up for gasoline. I lived through that. Bare shelves and you couldn't get certain things. It wasn't that every supermarket shelf was bare the way it was in East Germany in the 1950s, but something was always missing. And that's still the case today. So, of course, prices went up and, people were trying to pay whatever they had to get what they needed. And energy prices were a big driver of that. So that feeds through as a form of inflation. The other kind of inflation is from the demand side. So the supply side is called cost push. Costs go up and they push it onto the consumers. The other kind is from the demand side. It's called demand pull. And basically consumers have a change in mentality. They're worried about inflation. They would say, hey, I was thinking about buying a refrigerator. Gee, I better go buy it today because if I wait for 6 months, the price is going to go up. Or apply that to anything, a new dress, new suit of clothes, whatever. And so you're pulling demand forward and it's behavioral. And that will also drive prices up. But they're very different things. Now, cost push can morph into demand pull. That's what happened in the 70s. It started from the supply side. But by the late 70s, 80s, and Volcker, which we've just been talking about, it had tipped over into the demand side. That hasn't happened yet. We've had the supply side inflation, the cost push. It hasn't yet tipped into demand pull. It hasn't really affected consumer behavior that much in terms of people anticipating more inflation. It could, but it hasn't happened yet. Here's why that's an important distinction. Cost push inflation negates itself. You know, the old saying that the cure for high oil prices is high oil prices because people can't afford it. Like, you know, maybe if demand is inelastic, if you got to fill up your Ford F-150 truck with gasoline to take the kids to school or go to work. But if you're unemployed, you're not buying any gas because you're not leaving the house. So it tends to negate itself, whereas demand pull feeds on itself. Powell has not made that distinction. And if I'm right, I think I am right, and the evidence backs that up, this inflation will come down, not because the Fed is raising interest rates, but because higher prices destroy demand all on their own. If I used to pay $75 to fill up my truck with gas, and now I have to pay $150, which is about right, I'll do it because I got to get to work. But that's $75 I'm not going to spend on something else. I'm not going to go out for dinner. I'm not going to go to a show, a concert, or buy a new camera, whatever it might be. So it does tend to depress demand, destroy demand, and hurt the economy. And then it slows down, and then the inflation comes down on its own. That appears to be happening. But Powell hasn't really made the distinction. He's fighting the last war. I hate to use a cliche, but he's fighting the Volcker War. And what he's got looks a little bit more like the Herbert Hoover War. That looks a little bit more like the 1930s than the 1970s. So the bottom line on all this is the Fed is going to raise rates at least twice more for the reasons I mentioned. Powell doesn't want to repeat the Volcker mistake. He thinks the battle's not won. He has to get to the terminal rate. In reality, he's probably already there, if there is such a thing as a terminal rate. It's another one of these things they made up. Inflation is coming down, and so will probably continue, but for really bad reasons. There were $1 trillion of subprime mortgages. These are mortgages that, no documentation, don't have to prove your income, very non-credit worthy. But there was a bubble mentality, a frenzy, and everyone, hey, buy a house and borrow money, fix it up, sell it for twice as much, walk away rich, and everybody was doing it. Mortgage default rates rarely get above 5%. 5% is really high in the mortgage market. So people were saying, smart people like Ben Stein, a financial analyst, but the central bank and others were like, well, okay, let's get crazy. Let's assume a 20% default rate, which has never happened, but just assume that's true. On $1 trillion of subprime mortgages, a 20% default rate would be a $200 billion loss, which was only slightly higher than the S&L crisis of the 1980s. Adjusted for inflation, it would have been a comparable loss. And the attitude was, well, we survived the 80s, we'll survive this. Yeah, it's bad, banks will take losses, stock prices go down a little bit, but we'll survive. What they missed is, yes, there was $1 trillion of subprime mortgages, but there were $6 trillion of derivatives. Yep. That was invisible. So all of a sudden, 20% of that was $1.2 trillion. So you create derivatives out of thin air, yep. And there's no limit on how many you can have. They're off balance sheet, meaning give me the balance sheet of the company, I won't see them. You have to read the footnotes and then the information behind the footnotes. So non-transparent, unregulated, no limit on size. So the crisis was actually much worse than anyone realized. And then when it started to collapse, the contagion spread throughout the financial system. My point about 2008, it was because we did not learn the lessons of 1998, and we flew right into 2008. But once again, we have not learned the lessons of 2008, and we're going to fly right into the next storm. In 1998, Wall Street got together and bailed out a hedge fund. In 2008, the central banks got together and bailed out Wall Street. Who's going to bail out the central banks? In other words, the point is each crisis is bigger than the one before. The intervention gets elevated, larger dollar amounts. And are we now at the point where there's no one left to bail us out? And one of the questions I'm asked most frequently is, okay, Jim, I kind of follow your analysis on how risk works and how complexity theory and capital markets, how that works. But where's the crisis coming from? What's going to be the catalyst? It's actually a long list. Now, student loans, there are $1.6 trillion worth of student loans. So this will go, and kind of this gets to your point, Francis, how do capital markets and money markets and Fed policy kind of leach into debt and deficits? So when a lender, credit union, or anybody, or university makes a loan to a student, and the Treasury guarantees that loan, which they do, it's off budget. Again, it's not strictly a derivative, but it is non-transparent. So then the student defaults, and the credit union, the lender, simply turns to the Treasury and said, here's your loan file, pay me. And the Treasury pays the lender because they've guaranteed the loan. Now it's on the Treasury. But until that point, that loss is not on the books of the United States government. That loss is not part of the deficit. But when the Treasury writes the check to make good on the guarantee, it does go into the deficit. So we think deficits are high now, but there's this $1 trillion tsunami of student loan losses that's going to pile on top of the structural deficits and make it even worse. So all these things are, I spend all my time analyzing these things. I see them all. I can describe them. I can see how they're going to converge into a worse crisis. But in the short run, people either ignore them or they just don't know anything about them. But why would Bernie Sanders even suggest that? And by the way, he's not alone. I think the other candidates of, Elizabeth Warren and Joe Biden and Kamala Harris, one way or another, have suggested that they would do something similar, that we need student loan relief, and that ends up going onto the budget and onto the taxpayers. But there's a school of economics, and I talk about this in chapter 5 of my book. It's called Modern Monetary Theory, MMT for short. Everyday viewers, everyday people to know anything about it, but more to the point, economists don't know anything about it. This is a new school of economics, if you want to think of it that way. So there is this modern monetary theory, but the leading scholar of modern monetary theory is a lady named Stephanie Kelton, who's a professor at the State University of New York, but she's the financial advisor to Bernie Sanders. What modern monetary theory says is that actually there's no limit on the amount you can spend. You can spend as much as you want, and the market will either buy the debt, or if they balk, the Fed will monetize the debt. So how much debt is there relative to the size of the economy? This is called the debt to GDP ratio, but the way it's a simple fraction you learn in the 5th grade. How much debt divided by the size of the economy? So in a simple example, if you had $5 trillion of debt and a $10 trillion economy, that fraction would be 1/2. So you would say the debt to GDP ratio is 1/2 or 50%. Today, the debt is larger than the economy. Yep. That ratio is over 100%. We have round numbers, about $23 trillion of debt and about a $22 trillion economy. So the ratio is about 105%, highest since World War II. That troubles me, it troubles other economists. But my friend Stephanie says, what's the problem? You could take it to 150%, 200%. 250%. By the way, that's where Japan is. Japan's at 250%. Greece is 175% or so. Italy's 135%. They're all still standing. Go to the Ginza, it looks like Times Square. So you don't see visible signs of stress. And here's the irony. Ben Bernanke would absolutely not agree with this theory, and he said so publicly. But Professor Kelton says to Bernanke, you proved our point. You were the one who took the Fed's balance sheet and quadrupled it from 800 billion to 4.5 trillion or so. You proved that you can print trillions of dollars of money without causing inflation, without causing high interest rates, without causing a run on the bank. So all we're saying is, you did it to prop up Jamie Dimon's bonus. We wanted to do it to forgive student loans. We may have different policy objectives, but the process is the same. What's the problem? Now, of all the things I've debated, for years I was dragged into Bitcoin versus gold debates, which I thought were silly. I mean, I don't like Bitcoin, I do like gold, but it's like fish versus bicycles. I mean, the debate never made sense to me, even though I did a lot of them. Of all the things I've had to rebut, this was actually the most difficult because it's superficially appealing. First of all, legally, it is true that the Fed can take their balance sheet as high as they want. There's no legal limit on the Fed's ability to print money. It is true that Japan has a much higher debt to GDP ratio, and they're still standing. It is true that the Treasury can borrow as much as they want, subject to periodic increases in the debt ceiling, which have never been denied. And the Fed can monetize the debt. So all the elements of the thesis are actually correct. So how do you refute it? And the answer is that legally it can be done. And if your goal is to print a lot of money and forgive student loans or give a guaranteed job or guaranteed basic income, whatever it is, in theory you could do that. But there is an invisible psychological boundary, and this is what
the modern monetary theorists don't understand, and I don't think Ben Bernanke understands it. There comes a time when people wake up and they say, I don't know what's going on here. I don't have a PhD, but get me out of the dollar. It doesn't. And so, I'll buy gold. I'll buy silver, land, oil, natural resources. I'll buy a new car, buy a house. Get me out of the dollar into something tangible, because I no longer trust the monetary authorities. I no longer trust the Congress. I can't believe that you're going to spend this much money without ceiling, without limit, without causing inflation. My inflationary expectations will go up. And the way to deal with that is to buy hard assets, starting with gold, but not exclusively gold. There, as I say, land, real estate, natural resources. They're all good. They're all good substitutes. At that point, interest rates will skyrocket. All of a sudden, the bond market will have difficulty selling it. The president of the Congress could take away some of the Fed's independence. All of these assumptions could come crashing down very quickly, very unexpectedly, and that's the problem with the theory.
China doesn't have any of that. None of it. There's no significant Chinese bond market. They don't have the infrastructure of banks and dealers I described. They don't have the physical infrastructure. And most of all, they don't have a rule of law. You can't trust the Chinese as far as you can throw them. I was a facilitator and then a participant in the first ever financial war game ever conducted by the Pentagon. We did this at a top secret location called the Warfare Analysis Laboratory. One of the things we did there, I was on the China team. I wanted to make it realistic. So I said, let's lie, cheat, and steal, because that's what Wall Street does, and that's a more realistic game. So I recruited a friend of mine who's fluent in Russian to be on the Russian team, and I had dinner with him before we went down to the laboratory. And I said, look, here's the plan. I'm going to persuade my China team colleagues to basically announce a new gold standard. And we've accumulated enough gold, and we're going to say, for now on, our currency is backed by gold. We're going to put the gold in Switzerland to keep everybody happy. We're going to issue notes from a bank created in London under English laws to keep everybody happy. Here's the thing. We're going to say, from now on, if you want our exports, you have to pay for us in this new currency. We're not taking dollars anymore. And furthermore, and if you want some of this new currency, you can deposit your gold in Switzerland, and the bank will issue you some currency, so you're in the system. Or you can trade with us and run a surplus, and then we'll pay you in the currency, and you can use that to buy our stuff. Or we'll give you loans. But one way or another, we're done with the dollar. And obviously, this is very forward-leaning, but the whole idea of a war game is to help the Pentagon think 5 or 10 years ahead. So the first thing that happened when you go to your embassy or conclave, you come out and you stand up at the podium, you announce your plans, and then everybody reacts and it's discussed, et cetera. The first thing that happened is there was a group. So you have the red team, the yellow team, the blue team, as the case may be, and they're all different countries or areas. But there's a white team, which are the referees. They decide what you did. And the first thing they did when we announced the gold move, they ruled it as an illegal move. They said, no, that's not in any of our scenarios. You can't do that. And I stood up, and about 100 people in the room. There were 3-star generals, CIA, FBI. I said, wait a minute. I said, this is a war. There are no illegal moves in a war. The whole idea is to be out of the box or live in a world where there are no boxes. That's what we're doing here. So they agreed. They said, okay, we think it's a really dumb idea, but we'll let you do it. Well, over the course of 2 days, it accelerated and gathered momentum. At the end of it, Russia got PowerPoints. Okay, so this was 2009. Within 10 years, so what facts happened? Within 10 years, Russia tripled its gold reserves. Last week, the dollar value of Russia's gold exceeded the dollar value of its treasury securities. They have 20% of their reserves in gold, and the value of their gold is more than the value of the U.S. treasury securities. They're dumping treasuries, buying gold. Exactly what we warned the Pentagon about 10 years ago. And here it is, and China has more than tripled its reserves. So we're not there yet, but we're moving to some kind of gold-backed world. But the point is, that was all in the war game. That's all in the book. And I made one other point. I said, currency wars don't happen all the time. They might only happen twice in a century. But when they happen, they can last for 10 or 15 years. That's how long it takes to sort out. What you describe about the Chinese money supply is absolutely correct. People in the United States complain, the Federal Reserve has printed $4 trillion in the past year. And they have printed $4 trillion in the last year. They're taking the Fed balance sheet from about 3.5 trillion to 7.5 trillion. So yeah, we printed $4 trillion in the past year. Didn't do any good, won't do any good, but we did it. But Chinese money supply is even larger and growing faster. Now, I don't want to get into the weeds on China's internal monetary policy. I could, except to say that they're grossly over leveraged. The economy is investment driven, not consumption driven. They're about 40%, 45% investment. The US is about 25% investment. So that gives you some idea of how investment is to the Chinese, which is actually okay if you're investing in productive assets that pay their way. They're not. They're wasting the money. I've been to China many times, been going back and forth there for 35 years. I've been out in the countryside. I don't just stick to the hotel lobby in Beijing. I got mud on my boots visiting these ghost cities. And so each ghost city, there are a bunch of them, actually seven. Imagine building 7 cities. That's what I saw. And so they got 1 or 2 skyscrapers, and they got mixed use, and they got retail shopping, a country club, a hotel, a golf course, a pond, highway stops, airport, etc. And it's all empty. I mean, it's just all empty. Shiny new construction, some of it still under construction, all empty. So I said to the communists, I said, what are you guys doing here? I mean, nobody's here. So, oh, don't worry. People will be coming from the countryside, and they will be populating these cities. And I said, when? I said, no one's coming. And besides that, you've already drained the countryside. That already happened. But I said, you cannot mothball a building. It's not like some old clothes. I mean, the way a building maintains itself, it gets occupied and there's maintenance and people fix it and all that. I visited, I used to travel a lot in Central Africa in the early 80s. Zaire at the time, today it's the Congo. I was in Kinshasa, but it was right after the 70s commodities boom. And they took the money, of course they wasted it, and they built these skyscrapers in Kinshasa, which is like a swampy, scary, funky, city. But there's a skyscraper, but the windows are falling out, and there were rust stains running down the side, and the elevators were broken. So it might have looked nice the day they built it, but it was never really used. And now it was literally, when I was there, it wasn't that much later after they built it, it was falling apart. So that's going to happen in China. My point being, if you apply, generally accepted accounting principles to their investment account, you would write it off the day they open the building because nobody's there. It's not worth anything. So they're wasting the money. They're over leveraged. They're overprinted. However, none of that has anything to do with the status of the Chinese yuan as a global reserve currency. The yuan is not a reserve currency. It will not be, probably in my lifetime, maybe never. And I'll tell you why. Because a lot of people don't understand what a reserve currency really is. You get a report from the IMF, and it says, 60% of global reserves are in dollars, which is true, and about 25% are in euros, which is true. So 85% of global reserves are in dollars or euro, which means the only meaningful exchange rate in the world is the euro-US dollar cross rate. Everything else is working around the edges. You got some sterling and yen and Swiss francs and a couple other things. Aussie dollar is tiny, believe it or not, good currency, but not a big part of it. And China's like this kind of invisible 1% sliced down at the bottom. And China has $1.4 trillion in its reserves. But here's the point. It's not as if they have pallets of $100 bills stacked up in the basement of the People's Bank of China. They don't. You invest in securities. In other words, they're dollar-denominated securities. So it's not actually dollars. They're treasury bills, notes, and bonds denominated in dollars. So the thing that makes a reserve currency is not the currency, it's the bond market. You need something to invest in. Again, so you need a liquid bond market with different maturities, different interest rates. You need dealers, you need auctions, you need payment and clearance systems, you need repo or repurchase agreements, futures, options, when issued trading, custodians, the rule of law. There's a whole massive infrastructure, which we started working on when Alexander Hamilton was, advising George Washington, and we've been doing it ever since. And others, Bank of England has done the same. China doesn't have any of that. None of it. There's no significant Chinese bond market. They don't have the infrastructure of banks and dealers I described. They don't have the physical infrastructure. And most of all, they don't have a rule of law. You can't trust the Chinese as far as you can throw them. And so they have no chance of being a global reserve currency, none. Same with the Russian ruble, same with a lot of other currencies, same with Bitcoin. Show me the Bitcoin bond market. Maybe you can get my attention, but not sooner. So none of those are going to replace the dollar. First thing, my wife hates me to admit this, but I was once a registered lobbyist in Washington. I ran an office there. I spent a lot of time on Capitol Hill. And the first thing I learned in Washington is you can't beat something with nothing. In other words, if you hate a policy or a program, you just hate it, you write op-eds, fine. You're not going to change it unless you bring something to replace it. So for all the criticisms of the dollar, and there are plenty of them, you're not going to dethrone the dollar as the leading global reserve currency unless you can show me what you're going to replace it with. And there's one and only one contender in the world today, which is gold. So that's a whole other conversation. I'm not saying we're going to be on a gold standard tomorrow. As far as China's concerned, yeah, China's a house of cards. It's going to collapse. It's going to be ugly. Hard to say when, but probably sooner than later. And they know it. And they're not going to be a global reserve currency. So we can put China to one side, but yeah, China's a house of cards. Now, getting it back to the United States, the first point, let's talk about stimulus first. So yeah, the Fed printed $4 trillion. Congress, we had $1 trillion, what are called baseline budget deficits going into the pandemic. So with no pandemic, we were going to have $1 trillion deficit in 2020 and 2021. Now, Congress put $3 trillion on top of that with rescue and bailout programs last March, April, and May. That was the CARES program, payroll protection plan, aid to hospitals, extended unemployment benefits, higher unemployment benefits, et cetera. And I'm not saying any of those things were bad. It was needed to keep things from getting a lot worse. But we put $3 trillion on top of this. So there's $4 trillion for fiscal 2020. They just did $1 trillion last week in the kind of final days of the Trump administration. So that's $5 trillion. And Biden has announced his plan. He's going to have a $2 trillion rescue bailout, so-called stimulus plan now. So that's $7 trillion plus the $1 trillion baseline for fiscal 2021. So there's $8 trillion in deficit spending in 2 fiscal years, $4 trillion of money printing by the Fed. Now, those are the numbers. That's not projections. That's baked in the pie. Just don't call it stimulus. It will have no stimulative effect. Does it, again, as I say, keep the lights on? Yes. Would just some people keep their jobs last spring because their employer got payroll protection plans? Yes. Did other people benefit from increased unemployment benefits? Yes. Was a lot of that necessary because things were in such bad shape? Yes. So I'm not arguing that side of it, but it does not stimulate. It's not going to get us out of the depression. Let me be very specific as to why, because I don't make claims without backing it up. On the money supply, you can print all the money you want, but Milton Friedman was wrong. The monetarists are wrong. The Austrian school is wrong. Money printing does not cause inflation. What causes inflation is something called velocity, which is the turnover of money. The money has to be lent and spent. Banks have to be lenders. People and businesses have to be borrowers. You have to be spending it, get it in circulation, in other words, in order potentially to have some inflation. And that's the technical name for that is velocity. Velocity is dropping, sinking like a stone. And by the way, it's been dropping since 1998. It dropped faster in the 2008 crisis. It's dropping faster today, but the trend has been very steeply down for the last 22 years. And so, nominal GDP, so the dollar value of all goods and services, leaving aside inflation, that's what we mean by nominal value. Nominal value of gross domestic product is money supply times velocity. How much money is there and how much does it turn over? Multiply one by the other, and that's your nominal GDP. And I remind people that $7 trillion times zero is zero. Meaning you can print the $7 trillion, but if you don't have any velocity, you don't have an economy. And so you can understand monetary policy is a desperate race between increasing money supply and declining velocity. One offsets the other so that you barely keep nominal GDP where it is. In fact, it's going to go down about 6 or 7%. We're not getting back to 2019 levels of output. If you take 2019 as your baseline, we're not getting back to 2019 levels till 2023. At the earliest. We're not getting back to 2019 levels of job creation, the number of people who have jobs until 2025 at the earliest. That's why I call it a depression, not a recession. Now flip over to fiscal policies like, hey, they're sending everybody $2,000 checks. And they are. The people are going to get those checks. And so the Wall Street, which usually gets things wrong. That's the first thing you got to know about Wall Street, because they don't really care about you. They care about rap fees and how they make money. So they're saying, all right, they're going to send out the $2,000 checks and people are going to get those checks and they're going to run right out. And they're going to buy a car, a refrigerator, paint the kitchen, whatever it may be. No, the first two things are true. They're going to spend the money and they're going to borrow the money and they're going to send people the checks. But when people get the checks, they're not spending it. What they're doing, they're saving it. They're either paying down debt, which is equivalent to savings, or they're putting the money in the bank, which is savings. So certainly if you lost your job, you're not going to take your friends out to dinner. You're going to throw the money in the bank or pay the rent. But even if you didn't lose your job, you look around, like maybe your spouse lost his job. Maybe your neighbor lost his job. Maybe you think you're next, like you have a job, but you're worried you're going to get fired next week. So you save it. And the name for that, economists call that precautionary savings, or, plain English, it's saving for a rainy day, except it's raining everywhere. So they are going to send the checks out, but people aren't going to spend it. And that's the reason you're not going to get the stimulative effect. But you are going to increase the deficit, which gets back to this debt to GDP ratio. So take the total debt divided by GDP, and that's some ratio. The research is very convincing, very clear. A number of studies show this, that up to about 90%, so 90% debt to GDP, you get a little bit of something called a Keynesian multiplier, meaning you borrow $1, you spend $1, and you get $1.10 of GDP, or you get $1.05 of GDP. And it works maybe temporarily, but it works when people won't spend the money, the government can. That's the idea. But when the debt to GDP ratio goes above 90%, that's what physicists call a critical threshold, or a phase transition. Now you're through the looking glass. Now the Keynesian multiplier drops below 1, meaning you borrow $1, you spend $1, but you only get 90 cents of GDP. But meanwhile, the debt went up $1. So what's happening to the debt to GDP ratio? This is going up dollar for dollar, but this is going up 90 cents on the dollar. So the ratio is getting worse. Guess what the US debt to GDP ratio is today? The answer is it's about 135%. So we're way past that 90% threshold. And by the way, who's in that club? I can tell you, Lebanon, Greece, and Italy. So there's your lunch table for four, the four super debtors league. And it just gets worse. And that ratio past 90% is a headwind to growth, because people look at it and are like, hey, I don't have a PhD in economics, but I just don't like what I see. And people understand correctly, and this is the behavioral adaptation that policymakers on Wall Street do not understand. But the behavioral adaptations, people look at it and say, I don't know how this is going to end, but it's going to end. We're either going to have a default, or we're going to have something like hyperinflation to make the debt go away, or they're going to raise my taxes. Not sure which, maybe all of the above, but I have to save more money to meet my lifetime goals in the face of some bad outcome that's going to come out of this. That's the real world behavior, and economists know very little about the real world. So the point is, increasing the money supply doesn't work because velocity is declining. Increasing deficits doesn't work because people are saving, not spending, and they're preparing for worse outcomes. So neither one of these, you can call it money printing or spending, but don't call it stimulus, because it doesn't stimulate. We're not getting out of this. And that's why I call my book The New Great Depression. People ask me, are we going to have a recession? And my answer is, we might be in a recession right now and not even know it. We could be facing a global recession, including China, but just focusing on the U.S. Because that's the Fed's sort of territory. So Powell saying, the economy is great is nonsense. What he said, by the end of the year, we could be looking at 4.2% unemployment, 3.5 to 4% interest rates, and, kind of 2.7% inflation. And you're like, wait a second, inflation is 8.6 today. How do you get to, 2.7, number one? And then what about rising unemployment and higher interest rates? How do you reconcile those things? He said all three of those things. But what state of the world could make those things come true? There's only one, which is a recession. A recession would do it. A recession will raise unemployment. Higher interest rates will cause the recession.